past us, but I have some relatives here who were lost electricity.
Oh yeah, it seems it's been a pretty bad storm.
Yeah, I don't know about in your family, but I kind of think that in-laws are outlaws.
All right, we're live on YouTube now, so
Okay.
let's go ahead and mute our microphones.
Thanks.
I did not hear what you said. Can you say that again?
Thanks.
All right. I'm going to go ahead and mute, and I'll come back to you about 2 minutes before we start. Thanks, Mark. Hey, Mark, this is Greg. You want to unmute your microphone, and then we're going to wait about a minute and a half, and I'll introduce you, and we'll get started.
Great. Thank you.
Yep, I can hear you. Thank you. Okay, Mark, we're going to get started. Let me introduce you.
Great.
Hello, everyone, and welcome to Money Show's virtual event. Next up is Mark Chandler, the Managing Director and Chief Market Strategist for Bannockburn Global Forex. Today, Mark is going to present Making Sense of the Dollar. At the end of the presentation, we're going to take some questions. So if you want to type them in the box on the right of the platform, we'll take those a little bit later. So Mark, please take it away.
Great. Thanks. Thank you. And thanks everybody for joining. I know it's been at the tail end of an incredible 3 days of presentations. And I know I'm the last one, and I just want to thank you for sharing part of your day with me. And what I'd like to do is just give you from a macro point of view. I know that like in golf, they say drive for show and putt for dough. And I imagine, to me, what it means is in the markets, people like myself with these big macro views are kind of nice, they're great cocktail conversations. But the way people really make money in the markets, I think, is not being right more often than others, but it's really about the discipline of risk management. But today I really have the pleasure really to take a step back and think about that big macro picture. And I think that maybe I should say something about Bannockburn. I've spent most of my career helping large S&P 500 companies, largest asset managers in the world, navigate the foreign exchange market. And about 2 years ago, I joined a small boutique that helps small and medium-sized businesses. And this is really an incredible thing because we all know as consumers, we go to the store, we buy a pair of shoes, buy a suit, buy almost anything, and we know that we're paying a retail price. And that somewhere along that food chain, there's a wholesale price. But when it comes to money, people think money is somehow special, but there really is a wholesale price and a retail price for money. I'll give you an example. These S&P 500 type companies, largest asset managers, when they buy the euro, for example, and that price is really in the spread between the bid and the offer, they're paying sometimes a spread of 1,000th of a cent. Now, in these small and medium-sized businesses that I'm working with now, when they get involved in foreign exchange, sometimes the banks are charging them 3% and 4%. That's the wholesale price, that's the retail price of money. And it's sort of like, I guess, like a big poker game, that if you don't know who the mark is at the table, you're it. And I think what that means in foreign exchange is that if you don't know that there's a wholesale price for money, that means you're paying retail. And so I spend most of my days these days helping small and medium-sized businesses navigate the foreign exchange market strategies. Usually they're operating, say, a year and less. Oftentimes it's 6 months and less. But everybody, it seems to me, is interested in the macro picture. And it reminds me of a story that they teach in Chinese schools about 5 blind men walking in the jungle, and they stumble on an elephant, but they don't know it's an elephant because they're blind. And so one person feels the trunk and says it's a snake. Another person might feel the ear and thinks it's a fan. Someone else might feel the tail and thinks it's a snake. And so what I'd like to do with you in the next 15, 20 minutes is just share a big macro view for you that I think is sort of like looking at a map to find where you're going. And so I'd like to just share that part of the elephant that I'm feeling. And this to me is the most important chart to consider. What this is this is the way the Federal Reserve thinks about the dollar. So a couple things. It should really read real broad trade weighted. I've got fat fingers. That should really read real broad trade weighted dollar. What that means, it's real in the sense that it's adjusted for inflation. It's broad, meaning broad trade weighted, meaning that includes our major trading partners. And so what you're looking at here is a chart of the dollar, a broad trade weighted measure of the dollar going back to the end of Bretton Woods. And at the end of next week, we're going to celebrate, maybe not celebrate, might not be the best word, but commemorate the anniversary of the end of Bretton Woods, August 15th, 1971, when Nixon severs the last links of the dollar to gold. And so what you're looking at here, and this is sort of the story I tell about it, is that this is, you can see as plain as the nose on my face, that there are three big dollar rallies since the end of Bretton Woods. The first one was the Reagan dollar rally. And that was the policy mix. That was about the tight monetary policy that Paul Volcker was pursuing. And that he began pursuing it before Reagan took office. So we still call it the Reagan dollar rally. And Reagan, of course, we think of him as conservative, but he really expanded government spending, both on social programs and on defense programs. And so we had this policy mix, tight monetary, loose fiscal. And if there's any like a takeaway that you could have right away, and it is that this policy mix, tight monetary, loose fiscal, is the best policy mix for a country's currency. And I spend a lot of time looking for countries that have that policy mix. So what happens is you can see that peak. That is the Plaza Agreement. The G7, actually at the time it was a G5, they met and they thought the dollar had rallied too far. And so they coordinated intervention in the foreign exchange market, persistent. It wasn't just a one-off, but persistently tried to drive the dollar down. And so that Reagan dollar rally, that Reagan Volcker dollar rally ends with the intervention, driving it down, forcing it into a 10-year bear market. And then we have the next rally, and it's the Clinton dollar rally. And I should specify that was the Bill Clinton dollar rally. There's some people that thought there was going to be a Hillary Clinton dollar rally, but this was the Bill Clinton dollar rally. And this was really a story of the tech bubble in part. I mean, this is when I had this account I set up for my son who just graduated college. And the only thing I bought in that account and during those years was Microsoft and Intel. We called it the Wintel. It was really replacing computers, carving out that capital broadening process, replacing typewriters with computers. And of course, this is also the time when, the first internet search engine. Imagine what the internet was like before there was a search engine. Netscape's IPO sort of was the first big IPO for search engines, very exciting. And that sort of was the Americans kept their money at home, foreigners were flocking to the US. That was essentially the Clinton dollar rally, but there's another twist to it. And the important twist, and you'll see why later in my presentation, but the other thing that happened is that Robert Rubin became the Treasury Secretary under Clinton, replacing Lloyd Bentsen. And there's a sort of rule that the Treasury Secretary from Texas has always meant trouble for the dollar. There was John Connally, who took us off the gold standard with Nixon. Remember, he was in that car with JFK when JFK gets shot. Connally was a Democrat, becomes a Republican, and he's the Treasury Secretary when we end Bretton Woods. Under at the plaza, as it was coming down, James Baker, also from Texas, was the Treasury Secretary. Lloyd Bentsen under Clinton was the first Treasury Secretary, and he, like Baker, like Connally, were willing to use the dollar as a weapon to try to get our allies, Europe or Japan most often, to do what we wanted them to do, and that was really open up their markets, stimulate their economies. And so when Lloyd Bentsen was replaced by Rubin, Rubin came up with this strong dollar mantra. And that's important. We had one vice president that said that a strong dollar meant it was difficult to counterfeit. And I know there's a lot of confusion about what a strong dollar means, but I'll tell you what I think Rubin meant. And that is that the U.S. would no longer weaponize the dollar. The U.S. wouldn't use the dollar, threaten to devalue the dollar to reduce the U.S.'s debt, or to extract advantages from our trading partners. And that strong dollar mantra lasted from Rubin from the mid-90s, lasted about 20 years until 2016 or so. So what happened? Why did that Clinton-Rubin dollar rally end? Partly it was a tech bubble, but partly during that period, the Europeans issued their own currency. And I was one of those guys who thought Europe always had a common currency. It was American Express. They launched their own currency, and they thought that we were picking on it. That is, the markets were selling it. The euro was born at around 119, and it fell to about 82.5 cents. So the Europeans helped coordinate a round of intervention to support the euro, which meant to sell the dollar. So the second dollar rally, like the first dollar rally, ended as officials took action. We go through about another 10-year bear market. And in 2008, my first book was published called Making Sense of the Dollar, published by Bloomberg. And in between Bear Stearns' failure, the selling to JP Morgan, and Lehman's failure, my book came out, Making Sense of the Dollar, and it forecast or anticipated a secular up move for the dollar. That is a big cyclical rally for the US dollar. And that's what we sort of had. And then about a year ago, I began getting more nervous about the dollar's rally, thinking, so this is a bit, this chart is more or less up to date, but you can see about a year ago, a little bit early because we had this COVID bounce, but I was thinking that we were rolling over. And the reason I thought that the third big dollar rally since the end of Bretton Woods was ending was because the policy mix had changed. Remember, we had a policy mix of tighter Fed policy for a while they were raising interest rates, looser fiscal policy. Again, that's that policy mix that I really like, and that had changed. We began going to a looser Fed policy and less fiscal accommodation. The other reason that I thought the dollar's rally was going to come to an end was because I was looking at interest rate differentials. And what typically happens in a late cycle for the dollar, that interest rate differentials begin moving against it, but the dollar continues to rally. Partly people think they can buy US assets because the dollar will give it a kicker. Those US assets don't perform. And the third reason I got bearish on the dollar, thinking that cycle was ending, is because I thought this is one area that I really agreed with President Trump, that the dollar had really reached like historically stretched valuation measures. I know there's a lot of dispute about valuation. I sort of like think of the KISS method, keep it simple, stupid. And I look at the OECD's measure of purchasing power parity. And the reason I like it is that when a currency, the major currencies, OECD currencies, they typically don't get much more than 20 to 25% beyond fair value. And I was looking at several of the major currencies were well beyond that. Even today, the euro is almost 20% undervalued against the dollar. So what you have then is this a big idea there that the three big cycles since the end of Bretton Woods, and I think that this dollar is rolling over. And this shows you, I mean, this chart is part of the fiscal, I should say the policy response. And the white line you can see, that's really the US, that's the Federal Reserve's balance sheet as a percentage of GDP. These others, I had to use a different scale for the green, which is the Bank of Japan's. You can see the Bank of Japan is almost 120% of GDP. The US is around 33%. The yellow line is the ECB, and that's to that right-hand scale. It's about 54, 55% of GDP. So the Federal Reserve has been aggressive, but its balance sheet as a percentage of GDP, so proportionately, the US balance sheet is really smaller relative to our GDP than other countries. So I don't really see that as a big negative for the dollar, though, of course, the balance sheet did expand quite sharply this year. Most interestingly, in the last several weeks, the Fed's balance sheet has shrunk for various reasons. And the dollar, as you know, has remained weak. This is what I was getting at before. This is the interest rate differential. You could see how now, where they are now, near zero, they've really been flattening out. You can see how far we were. And even though the dollar was strengthening last year, you could see that interest rate differentials were coming off. And to me, it's sort of like going to a good butcher when I was a kid, and you'd be able to tell the butcher what chicken you wanted, and the butcher would grab the chicken. I'm sorry.
Mark?
Yes, I'm sorry, am I still live?
You are. Yeah, we got bumped off here in Sarasota, but you're still live and you've been making the presentation. So
Great,
sorry.
thank you. So I was saying how that I thought that this interest rate differentials moving against the U.S. was a bit like going to a good butcher, getting a chicken. The butcher cuts the head off the chicken, and the chicken body still runs around for a while. And that's what I sort of think about as interest rate differentials move against the dollar. The people who are still long the dollar don't realize it so much; they don't feel it. But eventually, this is like a gravitational pull. So we've got interest rate differentials already turning against the U.S., and now you could see it lost whatever interest rate advantage it really had. It's really collapsed. But one of the reasons why the dollar had been strong, of course, was this is part of the story. And this is that it's an incredible story that still is hard for me to get my head around. And this is the size, the dollar value of negative yielding bonds. Almost 16, excuse me, as on this chart I took at the end of the month, almost $16 trillion of negative yielding bonds in the world. And this is, I think, part of the story that's elevating risk assets of all kinds. And by that, ironically, I put gold in that category, stocks in that category, currencies, how we express in the currency market, the high beta currencies, like the Australian dollar, higher for the year now against the dollar. Several currencies are, but typically in a risk-on environment, the Aussie, Kiwi, and the Scandinavian currencies lead the way. And in fact, the euro has really been more of a middling currency so far. But negative yielding bond is still getting my head around what negative yielding bond, what it really means. But it seems to me that at one point it really attracted the money into the U.S., especially during the initial outbreak of COVID. But now I think that these negative yielding bonds, people are really pouring money into Europe. I think playing the carry trades in Europe, buying peripheral bonds, and keeping their money in Europe rather than buying treasuries. You know, many people think with all this debt, what about interest rates? Isn't this going to force interest rates up? And regardless of where you are on the MMT debate, I think this chart really illustrates. So this chart goes back to 2000 from JP Morgan. And what it shows you is how debt, the blue line, has been going up as a percentage of the world's GDP. And the black line shows you interest rates. So again, there doesn't seem to be in a short run, or in this, it is in the long run, this is 20 years, necessarily a link between interest rates and the supply of debt for various reasons, some of which include, of course, central bank buying. But also, I wonder if the Federal Reserve wasn't buying bonds and the ECB wasn't buying bonds, where would yields be? And I suspect that the bond yields would be lower, considerably lower, if the central bank stood away from the market, because that would take away the monetary stimulus that's helping to fuel what seems to be an economic recovery. Now, there's been a rash of articles written lately claiming that the decline in the dollar will undermine its reserve status. This is probably the most authoritative source. This is from the IMF. They call it the COFER data, C-O-F-E-R. And if you could Google that, COFER, IMF, and you can get their historical data on the reserves. And this right-hand table, or chart rather, this bar chart, shows you how stable it has been. It is as if the central banks have more or less individually agreed, but collectively, individually acted, and collectively what it looks like is about a little bit more than 60% of reserves are kept in US dollars, a little bit more than 20% in the euro, and the rest of them could be split between the Japanese yen, the British pound, Aussie and Canada in recent years have increased. And there's been some pickup in the Chinese yuan, but it's very small and still seems to be, say, less than 2% or around 2% of global reserves compared to the dollar, which I say is just above 60%. There's some concern that the dollar is going to lose its reserve currency status. And in my work, I put it this way, that the dollar has all kinds of problems, but all the other alternatives are more problematic. And it's also a bit like our keyboards. We all use the same keyboards, the Q, W, E, R, T. And what's interesting is that there's better keyboards. There's more ergonomically designed keyboards where your fingers would have to move smaller distances. The problem is that there's like inertia. Something that's going to replace my keyboard has to be not just a little bit better, but a lot better. And so behind the US dollars' role in the world economy is a deep, liquid, transparent bond market, and much more liquid and transparent than other markets. And so if you were a foreign central bank and you got billions of dollars to invest, the US Treasury market, there's still no compelling alternative to the Treasury market. And so I think that's the key, I think. And until there's an alternative, a compelling alternative, I think we're in this kind of world where it's not the dollar is not the only reserve currency, but it's about 60% or so. And the role of the dollar, think about it more broadly, I think of it as a numeraire, in the sense that it's the number one currency. Commodities, many commodities are priced, invoiced in dollars. Trade is conducted often in US dollars, as the dollar is an invoicing currency, even when the US is not one of the parties, or US company is not one of the parties. In addition to that, as you know, many countries and companies issue dollar debt, and that's, again, widening their investment base, all kinds of good depth of the Treasury market, the depth of the US bond market, all helping encourage this role for the dollar. And so I'm in the camp that says you can have big price swings. And here's what to think about is that even while the dollar had role in the world economy hadn't changed, in 2008, the last time the dollar reached a cyclical low, the euro was above 160, the pound was above 210, and both the Aussie and Canada were worth more than $1. So we could have these, my point here would be really just to encourage you to think. I'm sorry about that. Somehow the wind blows the wrong way and I lose the connection.
You're back, Mark.
Okay, so I'm sorry. I don't see my there. No, I don't see my screen.
Let's see.
But anyways, I think I could like wrap this up without looking at my PowerPoint. And it's just that the point there about the dollar is just to separate the price action of the dollar from its structural role in the world economy. And so I just would leave it at that. I have the last slide. I'm not sure if I could get to it. Just a summary, really, of these. Let me see if I get that screen again here. Bear with me. Sorry about that. And let me just forward here. This is the takeaway slide. Just some things to think about. So again, this is the big macro view, and it's not a substitute for prudent and disciplined risk management. But I'm suggesting that the dollar has entered early stages of a multi-year bear market, which is one of the things I really love about foreign exchange. The moves, the cycles, the trends last 5 or 10 years. And there I put just where those currencies were trading in the last cyclical low. I'm not saying it's going to get there today or tomorrow, but it's really just to think that you could have large swings in the spot price of the dollar and not undermine its larger role in the world economy. As I said, for me, the fundamental case has deteriorated. And what I try to do, and it's a tough balance, is have a big macro view and just try to understand the currencies on a day-to-day view for our clients to help them and to help them sort of sort out the noise from the signal. And lastly, before turning into some questions, let me just share with you some things that concern me. First, I am concerned about the election in the U.S., thinking that no matter what happens, it's going to be messy. The results aren't going to be known on the same day. The mail-in votes are going to be counted. Sometimes mail-in votes have to be like postal stamped on the day of the election, but they might not get there to where they're headed towards for a couple of days and then have to be counted. And we've seen some cases where the mail-in vote overwhelmed or really determined, offset, or I should say changed the way that the in-person voting went. And there I could just see the kind of trouble, especially in our current political climate, that would cause. So it wouldn't surprise me to see volatility, now that we're within 3 months of the election, volatility in the currency markets just to be pick up a little bit as people seek some of that protection from what could be a very uncertain period, which probably dovetails with the, say, beginning of the fall season and the flu season. I'm concerned that there's a rise of economic nationalism, regardless of who wins in November. I think it's bipartisan in the United States, and I think it's also evident, of course, in China, in Europe, and Japan. So I am concerned about the rise of economic nationalism, partly for what it means about inflation, what it means about trade, what it means about tolerance. And lastly, I'm in that camp that thinks that the U.S. and China are in a Cold War. To me, what that means is that going forward, almost all the macro issues, geopolitical issues, as well as things like the environment, are all going to be colored, influenced by this conflict between the U.S. and China. I think already, the one world wide web is breaking down. The other day, the former trade representative for the U.S. in Clinton's government wrote an op-ed piece accusing the Europeans of techno-nationalism. I can see how, before the crisis, before COVID, the U.S. was importing about 95% of our penicillin, for example, from China. That makes no sense. And you can see many countries besides the U.S. trying to onshore more medicine and medical products. From China's point of view, I'd say two big issues that they're trying to bring home. One is semiconductors, sort of the key component of modern technology, consumer technology. But the other thing they're trying to, bring onshore, bring to their own, is think about this from a Chinese perspective, that anybody in the world really, they're sort of captives to a duopoly in the United States on mobile operating systems, right? OIS and Android. It makes no sense for China, given the tensions, it makes no sense for China not to develop their own system. Early in my career, when we'd go to Japan, we'd have to have a separate phone because their phone system was different than we had in US and Europe. And I think the same thing's going to happen in China. You have to have Chinese apps on a Chinese phone to access, to even be a consumer in China, ride-sharing apps, for example. You're not going to be able to use what we have in the US or Europe for much longer, I imagine. And that increasingly you have to take Chinese cell phones, Chinese apps. So I'm concerned about, these are those three things that I sort of would list of things that I don't want to say keep me up at night, but keep me thinking about what's going to happen, what the future is going to look like. So with that, let me just wrap it up. I thank you very much for your time and patience with me, and happy to, I don't know if I can answer questions, but I'm happy to entertain them.
Thanks, Mark. Great presentation. Really interesting. Really interesting. So here we have a question from Leo. He says, are there any signals internationally or domestically that the retail investor can monitor, like carry trades, potential defaults, unusual foreign currency activity, etc., that would signal a dramatic movement in the dollar that could warn us of a worsening global economy in the next 1 to 2 years?
Wow, thanks, Leo. That's a great question. And it really lets me go to my next slide, which is how to contact me. So I have this I live in London hours in the US on the East Coast. And so what that means is I post a overview of a macro and a bit of the price action every morning by about 6:15 a.m. in the East Coast. But I do think, though, there are, of course, other ways besides my blog called Mark to Market to track these things. I think that and of course, Bloomberg is just outrageously expensive for most traders, retail traders. I think it's about $1,800 a month. But I do think that there's ways to follow it. The first thing I do when I get up is I see the price action, because it's sort of like where there's smoke, there's fire. So where there's big price action, and there's lots of places to look at foreign exchange prices, equity prices, and bond prices free on the internet. And so I look at prices, and that really tells me where the story is. But people like myself, I think, who are sort of have one foot in this trying to help small and medium-sized businesses, the other in this institutional policy-making framework, I think we all are struggling with the same thing. But a lot of people like myself are writing and analyzing, and a lot of it is free. And there's a lot of platforms that are aggregating this, like Forex Factory, FX Street, Seeking Alpha, Talking Markets. And these are just some websites that aggregate a lot of different people's views. And I find myself, if I find that elephant analogy that I began with so important, it's important to me that I read things I don't agree with. In fact, I'd say I spend most of my day reading things I don't agree with. But the important thing is that it either makes my views, changes them, makes me right, gets on the right side of the issue, or it strengthens my conviction. And so I just would encourage you to read broadly and be specific on what you're looking for. And there's places on the web that I think you can find prices as well as news for free.
Great, Mark.
And of course, check out my blog.
Right. We have one more question here from Quentin. He says, do you think a well-designed and decentralized central bank created cryptocurrency might be a way for a group of countries to replace the USD and SWIFT payment system as the world's central currency?
Well, that's a very fascinating idea. And there's Mark Carney, who ironically was also the Bank of Canada governor, and then he was the Bank of England governor. He gave a speech about a year ago where he suggested something along those lines, which is a digital international reserve asset. I'm sympathetic to the idea, but I think it's politically unrealistic. Who's going to do this? It seems to me, for me, from my perspective, nationalism is on the rise. International cooperation is not so strong. I think that whose interest would it really be in? If you think that, well, maybe a handful of small countries, I'm not sure that it matters so much. And I think that they'll find themselves. Think about what happened with Venezuela a few years ago. They decided, Chavez decided he no longer wanted dollars. The U.S. was giving all these sanctions, so he put the reserves in gold. And then he needed something liquid to intervene in the foreign exchange market or to pay some debt. And he had to liquidate his gold. And I think a large U.S. investment bank made him take a very big haircut on the gold. And so I think that these ideas of a global currency or even a regional currency, they sound nice in theory, and they definitely would solve a lot of problems. But I think that sort of, if I tell you the Aesop fable about the about the mice who are being terrorized by a cat. And so they have this town hall meeting, good Democrats, and the Democrats with a small d, and some mouse comes up with the idea, let's tie a bell around the cat's neck. So whenever the cat comes by, we could hear it. And everybody agreed, what a great idea. And then they were looking for volunteers. And I think the same kind of story here, that I'm interested in the concept of digital currency. I think that China might be the first, using their own patents, by the way, to develop this digital currency. I don't think it means anything about the reserve status. And I think you have to think about where the countries who might adopt a cyber currency, instead of just digitalizing their own currency, what are they going to pay for imports and exports? Which is ultimately why people use the dollar as well, because Australia sells iron ore to China, invoice in US dollars. Thank you very much. So I like the idea. I just think that the current political climate won't allow for it.
Okay, thanks, Mark. I really appreciate the presentation today. I've got a couple of quick announcements here I want to make. And again, thanks for a great presentation. Everyone, since our presentations are done for the day, please remember to take some time to browse through the interactive virtual hall, where you'll find lots of things in the booths there with prize drawings, exclusive offers from exhibitors and sponsors, research reports, and much more. And the hall will be open until midnight tonight, Eastern time. So please take advantage of this extra time if you've not already visited the hall. And as a reminder, I just wanted to point out, if you would like to replay some of these sessions on demand, you can learn how to do that by visiting virtualpass.moneyshow.com. Your virtual pass will include video and audio recordings from more than 30 hours of educational presentations from this virtual event, including slide presentations from the speakers, like Mark's, so you can review the key points at your leisure. And I also want to say thanks to our sponsors, media partners, and all who attended, including those of you on the seminar today. Over the last 3 days, we really hope you enjoyed the show and got a lot out of it, and hope you'll join us again soon. Want to mention also that our next session virtual show like this will be held August 18th through 20th. So please visit VegasVirtualMoneyShow.com to learn more about that program. And you can find out about other upcoming events on MoneyShow.com as well. So after you check out that 18th through 20th event, be sure to sign up and attend for future updates, and we'll send you reminders when you're leading up to the show. So thanks again, everybody. Have a great evening, and please come back and join us again. Mark, take care.
Thank you. Thank you, everybody.